Welcome to another episode of Let's Chat. I'm James Rogers. I'm the founder of Property and Poppadoms, and we've got another exceptional guest for you today. But first, I think we're going to introduce our sponsors. So, Luke, if you'd like to start off with, I suppose, Property Filter.
Property Filter. Well, what can I say about that? We're entering a new year, 2026. And if you are, I've heard a lot of the phrase Luddites at the moment when people talk about AI and the Luddites destroying all of the new technology. If you don't know that, check your history books. But I think that people are starting to realise that the old way of looking for property isn't working, and that Property Filter gives you incredible AI-driven tools that are going to allow you to find your next deal just like that. Super easy. So check it out. We've got a great deal with them. James.
So once you've found your deal, obviously you're going to need it funded. So we've got two other sponsors and podcast associates that will help you do that. So first up, a new one, we've got Roma Finance. So they can provide you short-term facilities and term debt as well. They've just released some products that cover Scotland now too. So very excited about seeing those projects get funded. And also 978 Finance, who can also arrange bridging finance and term debt at intermediary-led lenders. So if you need any project funding, so whether that's short-term or term debt, those guys can sort it out for you. But let's get cracking with today's episode. We've got our favourite guest of the show on today. I know I said that about Paul Lamphere, but
Sorry, our most returning guest.
Most returning guest, and my favourite person in the industry. I don't think it's any secret who that is. But Luke, would you like to introduce him?
The one, the only, incredible Adam Lawrence. Good morning, Adam.
We're not boxing, are we? That
No,
was
we
let's
are.
get ready
It's
to
very
rumble.
Bruce
Let's do it, though.
wasn't
Let's
it?
have these kind of intros. I think
love
a
it.
man of your stature, who is a heavyweight in the industry, needs no less introduction than that, Adam.
Thank you so much. I'm delighted to be back again.
Well, it's not. It was 12 months ago that we were sat. I think it was one of the first podcast episodes we recorded here, wasn't it, James?
I think it
was
was
the first one, the
Yeah.
inaugural
Yeah.
episode. And you were sat here and you told us your predictions for 2025. So I think it would be a good place to start with what were those predictions? What did you get right? What did you get wrong? What surprised you most, Adam?
I'm a big fan of going back and talking about what you did forecast and also being held to account. And guess what? Some of them were right and some of them were wrong. I remember certainly we've talked about the very property-specific ones. First of all, the big ones. How much was the housing market going to move? I said 3.75% upwards, capital growth-wise. We've had so far, the Halifax and the Nationwide have said it's somewhere between 0.3, which I think what the Halifax said for the year, and 0.6 for the Nationwide. So obviously I've missed the mark. I go by what the Office for National Statistics say, who haven't released their figures yet, but I think they'll be at about 1.5%. So I will have missed the mark, bit too bullish. Why? Which is the important bit, right? Why did that happen? I think I possibly underestimated the dampening effect the stamp duty reintroduction at the lower levels would have. And of course it makes sense, people have only got a certain amount of money. Cost of living has still been problematic, and if you're taking more sugar out of the tea as the Treasury, and we know that the Treasury have been taking all the sugar out of the tea in multiple ways in all of our lives over the last 18 months or so, then that's what you're going to get realistically. So I can understand why I was wrong. I said the base rate would be cut twice. It was actually cut 4 times. However, I feel fairly vindicated on that one because what I also said is don't expect the mortgage rates to drop too much. And I usually specifically talk about the 5-year mortgage rate because that's my rate of choice, rate of preference, the rate that I use, the rate that James has to process for me multiple times a week quite often. And don't know how he stays as patient as he is, to be honest with you. But that didn't move an awful lot. And there's a bit of a flaw in there, not FLAW, but FLOOR flaw around how cheap it can get, really, because the longer-term debt still looks a bit more expensive. And I think we are where we are on that sort of stuff. So I was pretty correct on where the mortgage rates would be, not so much on the base rate. But having said that, in my defence, where they have cut 4 times rather than 2, all of those decisions apart from one were 5 votes to 4, which is as close as you can get to agreement on a committee. They don't agree, and I would probably be in the camp that were, if I was trying to do the right thing for the country, which of course I would do if I was on the Monetary Policy Committee. This is not an advert for me to be on the Monetary Policy Committee, right? But if I was, I would try and do the right thing, and I would have been voting to hold because I think it probably needed to stay there. Having said that, you could argue, apart from anything else, unemployment, which has done badly over the last 12 months, certainly in the private sector, the economy needs a little bit of a nudge forward. And it takes 6 months plus for the base rate really to feed in. And there is a bit of irony in some of the Labour Party social media, very, very cringeworthy, you know. But when they're saying they've cut the rate 6 times since we come into power, and there's people like me answering saying that's because they're concerned about how badly you're running things, which is not really true, right? There's a little bit of tongue in cheek, but not the base rate doesn't always go down for good reason. And pretending that it does, and misinforming the general public, I'm not a big fan of all of that. Any other predictions that I can really think of? I said transactions would go up in volume. I think I said that. I certainly said that in my broader predictions. They did. So the market was pretty healthy in terms of transaction volume. And of course, what we see when the market isn't going very well, isn't maybe performing particularly well, is that transaction volumes dry up before we have an issue with pricing as a general rule. So plenty more transactions. 2023 was a bit of a desert for transaction numbers. Fair bit better in 2024. And we had another 50,000 plus more transactions in 2025. First-time buyers are out there. They're motivated. They're doing okay on affordability. It's not so much the actual bricks product with the mortgage putting together that's been the problem. It's more all the rest of it that goes along with it, with your energy bills rising and all the rest of those sorts of things. It is tougher for anyone who's got a roof, whether they own it or they rent it, because all of these costs have gone up. So we're all personally feeling that. I know when we're having that conversation, but the whole country is feeling that at this time. So I think I was pretty much spot on that one. I can't remember any other particular ones unless you guys can, and I'm trying to avoid any that I got wrong, but I'm not wired that way, so I'm very happy to be held to account if you can remember any of the others.
No, I think we spoke very broadly about the UK. We touched on, as we said off camera, large corporate buying up and making a large percentage of transactions in Germany, and you touched on the USA as well. I think what I take away from what you're saying is there's still a moving marketplace. There are motivated sectors of it, so like you say, first-time buyers, but there's not without their issues in terms of their energy bills and whatnot going up. There are definitely motivation, or I'm certainly seeing that in landlords. There's motivation to leave in terms of exit the marketplace, and there's motivation to buy in terms of people like yourself that are still benefiting from that situation, and individuals not necessarily educating themselves around legislation that's currently taking place. So I think that was a very good recap of 2025. I think now if we look into 2026...
Just before we do, though, I'd be really curious, Adam, macro level, that's what you thought would happen. That's what didn't happen. Well done. Kudos to you. However, in your own personal investing, what was your biggest lesson or challenge that you had in 25 that you've learned from that you're going to take into 2026?
Also, one of the things that we've been doing for a few years is kind of there's multiple ways of describing why we do this, but proving the liquidity concept, I suppose, is one. So if you think about when you own a lot of property and it is largely individual units, one of the good things is there's a lot of flexibility. One of the bad things is that's a lot of roofs and all the rest of it, and a lot of boilers and a lot of all the rest of it to look after. But when you value a property, right, what's usually going on? You might value it based on, if you're sensible, you might use Property Filter, right? They've got a model to do that that'll help you out. You might look at what's sold, and this is what you should do, really. Look at what's sold, not what's on the market, because asking prices are just that. Huge percentage of stuff does, only about 53% of stuff that goes on actually goes through to exchange, which is a stat that just blows my mind apart from anything else, but that is the stat. You should look at what's transacted, ideally in the last 6 months, ideally in the nearest quarter mile. Not always possible with houses, right? Sometimes you've got to go a bit further out, you've got to go a bit further back, but you know what it's worth. Are you going to get that number in the bank when you sell it? Spoiler alert, no, you're not, right? You've got lawyers, you've got estate agents. These are people that you need. If you're using an auction to dispose of stuff, you've got those fees. You've also got that cost of living. These days, you're paying that whether you live there or not. So council tax, there might even be double council tax to consider. Energy bills, all right, standing charges. You're not using a lot of energy, but you've got to think about all of that. And then there's that little bit of negotiation. There might be. And sometimes, if you're practiced at these things, as we are now, you might get a little bit more money than you thought you were going to, but also you might get a little bit less. So we only realise sort of 91 to 92% of the lower value units that we sell, because those costs, obviously some of those fixed costs like legal fees, make up a bigger percentage when you're selling a cheaper unit aside from anything else. And if it is on the market for a disappointingly long length of time and it's 9 months before you complete, that's sucked a decent percentage out of the book there. So I'm now in the place where that's built into the business model. And so regardless of the market conditions, regardless of if there's a budget coming up and everybody says, oh, now I haven't suffered from trying to sell houses that are worth over £500,000. They don't stack up for my rental model. Certainly not in this day and age with the interest rate being the way it was. But there was a point when that just evaporated, right? Now, I was a big beneficiary of that in 2024 because I was a buyer who stuck around when everybody was worrying about the budget. And I did things that other people didn't necessarily do. This time around, it didn't work in the same way. And it never does. You need to react to these things. What we saw was a freeze in people who houses above 500 grand putting them on the market. And actually, where I am, on the bright side, I didn't suffer from your nationwide's 0.3% or Halifax's 0.3% capital growth problem. My stuff was still going up 2-3% a year, nice and steady. My prediction was probably nearly roughly right, he says, trying to justify why he got it wrong, right? But it was nearly roughly right in my, and of course that's my wheelhouse. I don't claim to have a fantastic prediction engine around the prices in London. I don't live in London and I don't invest in London. I do navel gaze quite a lot. I do read a lot of stuff as is broadly documented, but I'm not going to know that as well as what do I think is going to happen in the Midlands, what do I think is going to happen in the Northwest, the Northeast. That's what I'd expect to be getting really right. So always a lesson in that you can't let the macro environment stop you from taking action. Warren Buffett is very, very goes to almost extremes on this level and says, look, we just sort of ignore it really. Although that's not proven to be true when you look at when Berkshire Hathaway has built big cash reserves in the past, which obviously they've got a big cash reserve at the moment. That's tended to be when they've been thinking stocks are overvalued. They're not stupid at what they do. They've been right. Then there's been a bit of an adjustment and there's been an opportunity for them to deploy some of that money. And they're approaching, 350 billion in cash at the moment, something like that. So they think, things are a bit wobbly, or they just think things are overvalued, and AI and things has made things very, very difficult to value. But you've got to proceed, you've got to get on with it. Taking action is always the way, and that's not necessarily a new lesson, but it's a worthwhile reminder. And also, because the macro side, and I did call it very well in 2024, did so much of the legwork for me, you aren't going to necessarily get a macro event that's going to be in your favour. You might wait years. I'm asking you to listen to the supplement once a week for something that might happen once every 3 years or something. When it happens, you're very glad that you listened, right? But that's the nature of trying to be a super forecaster or whatever. You've got to stay on top of the news once a day to get a result once who knows how often. So keep calm and carry on is always what I say. And it was a good year to do that because people who have, as James sort of, alluded to, this great replacement or whatever you want to call it. And there's many ways you can frame this one. There's this huge exodus of landlords. There actually is. Yeah, sure. Who's buying them? Landlords mostly, right? Vast majority are being bought by landlords. A big agent who I know in the Midlands shared some data with me, very kindly of him. And he said of all the properties from landlords that he'd sold in the last year, 84% of them were bought by landlords. So the other way of looking at that is 16% were not bought by landlords, probably by first-time buyers or similar sort of level of stock. But there's not a giant collapse in the rental market when 84% of them are just changing hands. And if that is a more broad, accurate figure, certainly for the Midlands, I wouldn't be surprised if that was the sort of number. There's still lots of companies being incorporated. There's still lots of activity in people looking to grow their portfolios.
So, because I recall it must have been around about 2021, and obviously I'm a big fan of the supplement, and we share it on the website weekly as well. You, in your closer circle, so Boardroom Club as an example, you were telling people that it might be an idea to pay ERCs and fix for that 5-year term, and you were predicting that, and that turned out to be very true and very correct in terms of your thought process with that. And I'm just sort of thinking that now we've got the people that have fixed around about 2021 and that are coming off those 5-year fixed rate periods this year. What do you think the impact's going to be there if they've not properly managed their portfolios for this year?
Phenomenal question. I will just qualify it by saying when I started getting really noisy about it in the broader circles, that was more like 2022.
2022,
early 22.
Sorry. I knew it was around about that time.
Those people who have followed the supplement, we'll be looking at that in the middle of 27. But one of the things I've said consistently since then was what it enables you to do is to do ongoing review of certain things. So I would hope that some of them, if they've got any problems coming, that they've solved some of them before we get there. That would be my philosophy and my expectation. But the point is absolutely valid, and this is the year. 2026 is the year. Why? Because 2021 was the nut low for mortgage rates. Really, really low. We were getting limited company buy-to-let 2.8% and things like that. And we knew it was great and too good to be true and all the rest of it. And some of that has probably enabled some people who, frankly, if they started to get in, if it was a new unit in 2021, they may well have overpaid for it. Some of this capital growth has not been swimming. It depends how badly they overpaid. I sold some houses in 2021, and I said at the time, I wouldn't be surprised if those prices aren't back there in 2028. And we've got a calendar invite in there somewhere to go back and check, just to see whether my sort of gut, and that's to an extent a gut feel thing, not a mathematical model thing, right? But a gut feel thing, and we'll see how that went. But these were ones they were, like they do in a hot market, they're selling at 10 or 15% above the asking price. Well, where's the money coming from, guys? And where's the capital growth coming from, right? So there is that 2 point whatever coming off those very low rates. We know people who've got mortgages at 0.8 and 0.7 and crazy home mortgages like that. Bit different with your own house because you've normally got a bit of something in the tank. You can kick the term out for a bit longer or maybe a lot longer. There obviously have been a number of measures put in place by the regulators to say don't make it too savage on everybody when they drop off. And they will be dropping off into a lot of a calmer environment. But my point would be, and they're dropping off into an environment where they've got a choice between a 2-year and a 5-year, and maybe some other choices as well, which that choice wasn't really there in 2022, early 23, because the 2-year had gone so wonky. It was 7-8% for a 2-year mortgage, certainly in the limited company space, and it was 5 and 6% for a personal mortgage. So we haven't got that huge disparity that we have, but we have got the bottom to the top. And one of the things that I fear in these situations is the market's done a lot of heavy lifting there for people. It's protected them. You genuinely could, in those times, buy whatever you wanted and make it stack up. You could have bought a £500,000 house that yielded 4.5%, right, and had it on a 3% or cheaper mortgage and had a bit of cash flow. And it would have been quite nice. Now, your problem might be that £500,000 house maybe hasn't gone up a lot in value, and now it will not work at a 5.5% buy-to-let rate.
It's not going to pass stress test.
It's got to go. Yeah. It's got to go. Or it might be okay on a remortgage, but you'll have to stay with that lender who gets special dispensation on the debt service cover requirements and things like that, as you know. But there is, I mean, if you take it all the way to social housing, a lot of the debt service cover in the broader social housing sector for the housing associations and the bigger providers is 91%. And what that means, for anyone who doesn't understand that, it means that the rent does not cover the mortgage, let alone the operational costs, which are massive in that sector. So the economy at the moment is full of these little problems where some of them could potentially be quite big problems, where if you did it today, for example, let's say you were interviewing someone who had a chain of pubs or something like that, would they buy a chain of pubs today? Would they build that chain of pubs today? And they'd say to you, no, the business rate's on their own, James, Luke, no chance. Wouldn't be worth it. Then the minimum wage, then all these workers' rights, then blah, blah, blah. So they wouldn't, but they've got them at the moment and they're open and they're making money. They're not making as much money as they would like. But what this boils down to in my way of looking at the world is they're putting in more effort and they're taking more risk for less return and a bigger slice going to His Majesty's Revenue and Customs. This is not a conducive environment for growth, particularly. This is I'm not working with you. You're not helping me out in any way. It's a relationship that a terrorist would have with a victim, right? It's not
Stockholm syndrome.
Well, no Stockholm syndrome because no one likes them. So there's no love. There's none of the end bit of the Stockholm syndrome. Just need FBI negotiators. Exactly. So, and that's I think some landlords might be listening to this and might identify with that point of view. And because I'm very interested in real world stuff and face value conversations, I get to talk to a lot of industry professionals and people in broader space than property in part of my day-to-day life. And a lot of them, it usually happens in exactly the same way. They sort of sidle over to me and say, like, almost whisper it, like, I've got a property, I've got a buy to let, I've got 2 or 3 buy to lets. All right, okay. Usually they've amalgamated them by maybe they've held onto a property when they've moved in the past or something like that. Very, very typical accidental landlord sort of status. And then what they want from me, of course, is the magic beans, the dust. And it's like, well, look, if it yields 5%, and actually it only yields 4% because you haven't put the rent up, you haven't managed the rent up over the years, what you've realised is you're now in a rock and a hard place where poor old tenant who, if they're paying 800 quid and the market's 1,500 quid now, and you need to go to 1,350 to pay the mortgage, the tenant's going to get a great, great big shock, right? Now, we could be quite harsh and say, well, the tenant should have known and tenant probably did know they were paying something cheap. Most people aren't sweating Rightmove or Open Rent or whatever every 5 minutes to see what their rental would cost. They might look when they get a rent increase and things like that. But that follows on with that. If there's a big jump in the mortgage rates this year, do we see more disposals? There'll certainly be in individual cases, 100% there'll be financial distress and people need to get rid of stuff fairly quickly. And the only way to be on top of that is do your figures today and review them, ideally on a monthly basis, certainly on a quarterly basis. If you need to, and it's quite simple because I hate when those people whisper to me, what's the magic beans or whatever they're trying to get me to say. The bad news that I normally give them is there are no magic beans, there is no magic dust, right? Or if there is, I certainly don't sell it for a living. There's 3 things you can do, right? You can keep it, you can cure it, or you can kill it. Kill it means sell it, yeah? Keep it means you're actually okay here and there's a bit of natural progression, it's going to be all right. How are we going to cure, because that's the more salty one? Well, we're going to look at alternative asset management strategies maybe. It only works if it's an HMO. Okay, do you really want to keep it? Do you really want to do the extra work? Do you really want to do more work for the same return or less than you were getting in 2021? Did you make a long-term decision on the basis of the fact that in 2021 it looked good on paper? I hope you didn't. I hope you realised that rates were probably at a historic low. You know, if you didn't, then it's kind of bad news. But if you've paid the frictional costs of getting back in are even higher today. So think about what I said earlier, and I'm only getting 91, 92% back out of what my units are worth. Well, I can't be buying units at 91%, can I? Because then I've got stamp duty. So you can see just from that mathematically what sort of discount I have to do to get replacement units in. Now, luckily, I can get that sort of discount. I've built my operation, so that's exactly the sort of deals that we do. Usually via discount rather than adding value. But we're not sitting here in 2026. My personal prediction for 2026, capital growth 1.5%. Primarily dragged down by London and the South East to an extent, so I'm not as bearish about that in where my portfolio is, but 1.5%. I'd be surprised if I was a million miles out, you know. So if capital growth isn't doing the lifting, what is? Has to be yield, doesn't it? Has to be cash flow. Now, that's not to say, and you shouldn't be looking and thinking about investing in property for what happens this year. You should be looking at the next 10 years as a minimum, really. Otherwise, go and do something else. Go and do some trading. Go and do this, that, and the other. But what I'm saying is you're not going to go to bed and wake up a lot wealthier, whereas there have been years in the past where I certainly remember years back in the 2010s where things were up 7 or 8% in some years, and I just thought, well, that's all right, isn't it?
Glory days.
I'll take that. I'll have a bit of that.
Absolutely. Apologies for misquoting you there on the supplement as well.
I always correct you, so don't worry.
I know. I need you there all the time, actually. A great overview there and some real important information. And I suppose it's just we're coming back to the basics. It's just you really, really, really need to keep a sort of tight management process on your portfolio because, like you say, if we've had a good tenant, I hear it all the time. We get sort of inquiries. Oh, we've had a good tenant, rent's low, got to put it up a significant amount. But then obviously tenants in a situation where it's gone up to market rent, but the jump's been very significant for them. However, they've got no other options really because everything else is the same price everywhere. So I think it's those incremental increases, you know, are really, really important over the term of the mortgage, just to sort of keep things moving along like they should be. Portfolio management, maintenance, keeping on top of things, which don't then cause huge impacts on your exit, which then affect value, of course. Luke, I don't know if you've got anything to say.
No, I think that's. I was just thinking then that it might seem, as a kind of starting as an accidental landlord myself, that sort of feeling like, ooh, I don't want to put it up because it's okay. But the reality is, as an investor, we have an obligation to our tenants in order to help them to follow the market. Because otherwise, these nasty shocks can be worse because they're not talking to their employers to say my costs of living are rising, and they're living in obscurity, and so suddenly they're hit with a shock. And I think we have to realise that it's worse when we act as an ineffective landlord. We think we're doing people a favour, but we are not. So we have to run our businesses like a business. And I think a lot of times people do not recognise property investment as a business. It is a unique way of creating a living, but it is still a business, and we have to see it as such.
Yeah, and there's touching on some really good points in there, and touching on one of the ones that I look at all the time that still gets me on my soapbox quite regularly is the idea of there's equivalence between renting and owning in terms of the cost of the rent versus the cost of the mortgage. And this is an utter nonsense. There was some stats released relatively recently that 20% of all flats that were sold around the country last year, people lost money. And as in, they definitely lost money because they sold it for less than they paid for it. So that's only considering the value of the property. Obviously a significant number. It's going to be 100 grand to millions of pounds or whatever, but no one's counted the stamp duty. No one's counted all the frictional costs in and out of buying and selling that property. And guess what? When people own stuff rather than rent it, they tend to invest more money back into the property. They're also paying for the insurance themselves. There's a whole number of differences between owning something and renting something. And actually what everyone's too scared to say in that situation, but people like me will say, is that if it's 20% there, it might well be 50% in the real world by the time you put in all those costs. And you're not very far away from drawing the conclusion that no one wants to hear. Actually, as a tenant, you'd have been better off renting it than you would have been buying it and owning it. Because look at the risk. Also, no one ever looks at, well, hold on, if the average deposit is 78 grand in a first-time buyer property or whatever it is, what could they have done with that 78 grand? If it's come from bank of mum and dad, that could have stayed in a savings account getting 3 or 4%, or they could have done something even more meaningful with it. And this is why that whole argument is had on completely the wrong level. But we start to get towards a cult mentality of, we can't even say that it might not have been better. Well, we can. I mean, in 2016, I was saying, what are you doing buying stuff in London? Why? Not because I predicted that in 2025 prices in London would go down, not at all. But what I could see is that we'd had 6 years of an incredible bull market run, and all the signs were there. The transactions were drying up. The sealed bids weren't there anymore. It was in fact, some of the data was showing it. The market had topped out. Well, if you're buying for capital growth, and a lot of people were using 2-year mortgages at the time and recycling and sucking them out, well, that's very speculative, right? And since then, since 2016, if they've held on to those units, they haven't made any money. And I see accidental landlords all the time saying, well, my property hasn't gone up. And I point out to them, well, the thing is, you didn't buy that as an investment. And you can't compare that to the genius you had when in 2022 you bought some NVIDIA because ChatGPT came out or something like that, and you read a good tip and you've made 500% on your money since then. It's not the same thing, right? It's definitely a different level of volatility, but also you made a researched play that has given you some rewards. You didn't have a house that or a flat that you lived in and then thought, well, this might actually have some use, so I can rent this out. That's not a strategic decision. And I'm not disparaging accidental landlords. I started as an accidental landlord. And guess what? Since I've been a deliberate landlord, those assets have performed a lot better than ones that I've accumulated along the way in accident or have held onto when I shouldn't have done. And just one more thing on what you just said. You build a culture in whatever you do. And if the culture is we never put the rent up, then when you do, all you get is, pushback and disappointment and anger sometimes. Whereas if the culture, and this is where the culture will be, when the corporates do own a lot more, and whether we get to BlackRock and all the rest of it, it's different kettle of fish. But even larger companies, what happens in sectors like this? The biggest number of units, if you say, here's a room of 100 landlords, what's the most hands that are going to go up when you say, how many properties have you got? One. Still one, right? That won't always be the case. Markets consolidate, they aggregate over time. This is going on in the broader estate and letting agency market. It's hard. The margins are squeezed. It's harder. Landlords are trying to get costs down, but you've got renters' rights. You've got more stuff to do, right? So costs really need to go up. Well, how can we survive in our one little office where James has to work 68 hours a week and Barbara has to lock herself in the cupboard for 4 days to work the rents out and things? Well, guess what? That's not going to work anymore. right? It's not going to work. And so consolidation happens. And that's what we are already seeing in this sort of, the great replacement is not rental with first-time buyers. It's mum and pop landlords, accidental landlords with corporate landlords. And they will consolidate. And there's much more incentive these days for the corporates versus, what do you want to do? Do you want to go out and buy a portfolio of 100 houses? What's the stamp duty like? It's pretty bad. Pretty bad. Even using the non-residential relief and things like that, you're going to pay 5%. Do you want to buy this limited company with 100 houses in? Well, you're going to pay 0.5% on the value of the shares. And that's just the stamp duty. You can go a long way with that. There's lots and lots of nuances with buying a company that lead them much more towards buying a company, right? So that's where we're going. That's where we're heading. Are we going there this year necessarily? Are we on like the full fast track? I don't think so. Right? I have conversations like this all the time with big size funders who say things like, we want to deploy 100 million quid. We want to do this. We want to do that. Okay. What's your strategy? How are you going about that? What do you buy? What do you not buy? I don't know. Thinking you could tell us, really. So, well, it's not my 100 million quid, is it? I could tell you, sure. But you can see there's a whole piece of work to be done. Do they understand that you can own 100 different rooftops the same way Invitation Homes have done it? I mean, it's fairly easy. You can just go and look at their business. They've written papers about that sort of stuff. They obviously they're on the stock market, so they're fairly transparent. They used a fantastic business model. They also had great timing and great funding in the US back in the 2010s. And now today they're exposed to the whims of Donald Trump, who goes, well, you shouldn't be owning all these houses. You're stopping other people from owning these houses. Now, I have some sympathy with Invitation Homes' point of view. You might say, well, of course I do, right? But what they did a lot of the time was they took near derelict houses or things that needed a huge amount of money pumping into them. They pumped the money in. Well, it's much more difficult to do that these days in the UK because if stamp duty, additional stamp is 5%, that's coming out of the deal before anybody started. What does that mean in the real world to my operation? We have to offer less than we would have done. What's the knock-on consequence of that? We don't do as many deals as we would have done. The only other alternative is we take less margin. Now, we're already taking less margin. We're not expecting the vendor to pay all of that 5%, but there's certainly a knock-on consequence to the vendor of it. And where we might have said, well, we can take a 22% discount, that needs to then become a 23% discount, and we're still eating an extra percent somewhere in our margins that have been squeezed in the same way that every business, unless you're an AI company, has had their margin, well, or if they've got any margin, because they're busy spending it all on R&D, obviously, so joking aside, but company margins have been squeezed, just like the pub owner I was talking about, just like, you can tell me any business where the margin has expanded healthily since the pandemic, I'm all ears, but I don't think there are any.
So that's certainly an opportunity for the future, so limited company purchase, share purchase, agreement.
Well, and setting yourself up to be sold. Think about it this way, right? I advocate taking a long-term viewpoint. If that long-term viewpoint is in 10 years down the line, you might want to sell. Yeah, there's nothing wrong with that. You're allowed to say it, like the cult says you're not supposed to say things like this, but again, I always do, right? Well, then be prepared for a limited company to be looking through your books, to be expecting well-organised, transparent reporting, all the rest of that. So start with the end in mind. Act as if you were, as Luke said, you've got to be business-like about it. There's no choice, in my opinion. Well, the other choice is get out or be belligerent and do what you were doing and let me know how you get on when you need Des Taylor services because you're in court for various lists of fines that a local authority has placed on you, you know?
So if we do move on to sort of 2026 in its entirety and your view of what that looks like, so risk, opportunity, where do you see this year heading?
So I think I would probably continue with that margin squeeze, not in the same way, in that, look, is risk going up from the 1st of May 2026? Yes, it is. What does that mean in the sensible world of investment? Well, we need bigger returns then, don't we? We need bigger returns. Has effort got to go up in terms of what landlords have got to do? Yes. Well, that also means I want bigger returns. Great. What's stopping us from creating bigger returns? Tenant affordability might be one thing. Yeah. Competition always stops us. Will competition go up or will it go down? If we've got fewer players, but they're bigger with deeper pockets than you or I or anybody else, is that helpful or not? Well, it is at the individual property level because they're not going to mess around with that stuff, right? So you've still got a good runway on all of that. And if you've got a big supply of people wanting to sell, not to be too economist about the whole thing, right? But if supply goes up dramatically, then what's likely to happen? Well, as I said, transaction volumes might go up, but prices are more suppressed. And there's going to be more of those transactions in there where people really do want to go. I'm sure, and it's very difficult to get data on this sort of stuff, lots of landlords over the last 12 months have tried to sell and then gone, well, I'm not getting the price. I mean, no one's more unrealistic about the value of their property than a landlord, right? So they go, oh, I can't, so I'll re-let it. Okay, great. And now what's going on? I gave a theoretical example of Rachel in one of my supplements that was based on Rachel Reeves, but, you know, she's in a funny situation in they've obviously have got 11 Downing Street to live in, but also her job's not that secure. No offence to Rachel. I mean, no chancellor's job is that secure. So what's she going to do if she needs her property back when now she's got to give the tenant at least 4 months' notice, right, and not in the first 12 months of that tenancy? There's so many things around renters' rights that are fiddly, and I think actually one of the biggest issues is going to be the idea that a tenant's going to give 2 months' notice, right? I don't see it happening. So that's the risk up, effort up, reward not necessarily up today, but I think reward over the coming years is definitely up as well, because that's how it works. When we saw this big adjustment in the interest rates, one of the things I said was rents are going to have to go up really significantly in order to reflect an increase in the cost of delivery for landlords to use mortgages. Right, they have to, because that's how and we've seen the market work like that, and people fight against it and be annoyed about it and get placards out against it or whatever. But it's just how that you want some provision, so this is how you've got to do it. So one way of looking at what the Labour government have done is impose much higher costs on tenants because they think they know what's best for them, which I'm fundamentally opposed to, right? But that's more of an ideological point than it is anything, because some people might say, well, good, they need to tell people what they need to have, but I don't know how many owners always do their own gas safes religiously every 12 months. I know that number's not 100%, and I've been in that non-100% at home when thinking, well, you know, it's safe, the boiler's fine, the flue's fine, nothing's cracked it, I can see it's all right. I don't need I might have a service, but I don't need
Not getting headaches.
Still breathing. So that side of things, but then ultimately, what's the opportunity that then generates, right? What's the opportunity that creates? Huge numbers of people selling. Are they selling vacant possession? No, not necessarily. A lot of the market drastically misunderstands tenanted stock and immediately assumes, oh, it's got a tenant in. They're selling it. Therefore, it must be the worst tenant in the world. Now, just peel back a layer of the onion. Oh, tenant's been in 9 years and never missed a payment. Well, hold on a second. Maybe we should be considering that that's the sort of tenant we want, not the sort of tenant that's standing in the way of anything. But so many people don't even look past level one, and there are multiple levels behind buying a property well, of course. So they've never been as cheap as far as percentage discounts go. And one of my predictions is definitely that percentage discount is going to increase as we approach May the 1st. But it's not like we'll get to May the 2nd and it's like, oh, that's the new world and we're all done, is it? There's a ton of people out there at the moment who don't know what renters' rights is, who own property. An absolute ton. Your accidental landlords and your people who are just not as engaged. I've bought many properties over the years, and people don't think about this, but even portfolio landlords who are disposing, I remember negotiating with one 10 years ago in the Costa del Stoke, no less, the hallowed turf, right? And I said to him, well, look, the trouble is I've got to pay 3%. It was when the 3% had only just come in, right, 2016. And I said, well, the problem is I've got to pay 3% extra on this. And he said, what do you mean? And I said, well, it's gone up. There's an additional premium on stamp duty. He had no idea. So, and he had 10 houses. So, admittedly, he obviously wasn't buying anymore and he was selling. But you'd still think he might keep the loosest of fingers on the pulse for these things. And when he looked it up and he found that he was like, oh, okay, well, I'll come down a couple of grand then and make up. Well, you eat a bit, I'll eat a bit, which is exactly what I said earlier, which is how the real world of markets and economics works, you know. So I'm always surprised how little a lot of people know. I mean, you know, someone sent me a message a while ago saying, oh, do you know if you've ever have you had many refurbs done? Yeah, a few hundred, couple. You know. You can get your stamp duty back, you know. No, you can't. No, you can't. You really can't. And I said, I've had this text. Look at this. Anyone who's ever done a refurb can have the stamp duty reclaimed. And I'm like, please don't do it. Please don't ever do that, because that's not what all that will happen. Is you'll pay someone for a service that's not a real service. And best case in the world, HMRC won't notice that you've effectively you've paid them to evade tax that you owe, right? So don't do that. So ton more opportunity, I think, both on market and off market, and lots of people who will, because, you know, this game doesn't move phenomenally quickly, but how many people have got, and I've known many, many vendors over the years, right? The seeds of sale get sprinkled in the minds. And when I advise vendors of businesses and property portfolios and things like that, I take them through this psychological journey that they're going to go on and say, because the first question is, have you ever sold anything like this before? Inevitably, the answer is no, right? Okay, so there's a few process things we need to go through. If we're selling a company, we need some expensive lawyers who are worth their money, right? But there's a lot. It's not like selling a house, right? There's a lot here, and it's plenty of forms to do when you're selling a house, right? But this is big stuff, yeah. So think about that. But also, here's the journey you're going to go on. So here you are today, strong and good, right? You're ready. You're not going to take 50p off the price. They're going to pay for it because it's great, yeah. But they're not. They're not going to do that because someone like me is going to come along. Hopefully not me, for your sake, because I buy it too cheap, right? But someone's going to come along, and if they're not a motivator, we start talking about motivation. If they're not a motivated buyer, and you start to become a motivated seller, shall I explain to you how this works? And then, as we get through the negotiation process, if someone tries to move a couple of chess pieces, we're going to end up having some pretty nasty conversations where you probably want to hit me in the face after we finish that conversation, because I'm saying, well, what are you prepared to swallow and what are you not? Because there's no magic dust here, guys, once again, right? This is the real world of it. But always be prepared. Multiple exits, which sensible people talk about all the time, always need to have potential multiple exits. Obviously, how do you protect against that? If you're doing what I've been doing and advising people on that sort of stuff, you make sure there's multiple buyers in the wings. And that's what any good estate agent would do. But the problem can be when you've got a lot of stock on the market, and especially if it's ex-rental, guess what? It's a bit tired and I don't really want to put a lot of money into it. And I've lived off the proceeds as a landlord, and that is the story that you hear again and again and again. And they don't even want to do $3,000 on a decorate a house and some carpets. And that's these days not going to buy you Axminster and the world's greatest decorator James Rogers to come around and do it, for example, right? It's proper bargain basement people. And they don't even want to spend that. Well, and how's the roof? Well, it's been all right for, so you haven't touched it for 20 years, is what you're saying to me. Right, and how's the boiler? Oh, that's from a strange part of the world, isn't it? You know, and all that sort of thing. And that's what then leads to, as you sort of alluded to earlier on, a significant haircut at the end of the life of the asset. And that my operation's built around avoiding those, right, deliberately. Do you know why I know that? Because all the stuff that I've bought has been like that, or a lot of the stuff that I've bought has been like that.
But it's about, and again, you're the absolute master at this. You buy at the right price. So any of the issues, headaches taken into consideration, where a lot of investors are they do take it into consideration to a certain degree, but you take it into consideration to the nth degree, and everything is scrutinized, and you know your processes and your systems in order to be able to complete transactions throughout the country from a single unit to a large portfolio are, the sort of the best I've ever seen.
Well, that's very, very kind. Thank you. And I'd like us to just repeat that for the rest of the podcast, if we could, again and again and again. No, but in seriousness, the entire skill in investment and also development, property development, but I mean investment even more broadly than property, is pricing risk, right? And that also includes, for me, pricing effort as well. And if you see, for example, there are estate agencies out there, I don't really want to mention any of them. I don't mind mentioning them if people want to DM me or whatever. But they very much specialise in below market value properties on the open market. Now, they might only be 5% off, 10% off. But the average investor, especially if they're busy, they can't buy that stuff left, right and centre. And they want to buy on their doorstep. If they can get one of those, happy days. That's a fantastic transaction for them to be doing. But if everything, let's use 10%. So we sell stuff 10% below market value, right? Okay. Should we buy it all? Probably not. Should we buy none of it? Probably not, right? So we still need to be able to sift through those properties that are on there and make good decisions about that's a yes, that's a no, that's a maybe, that's the one where the price needs to come down. And I could try and be as, as thoughtful around and as academic and as whatever about, how clever we are about pricing things and things like that. And price is a bit of a blunt tool in a way to do it, but it is a very, very safe way to do it. But also sometimes you haven't priced it correctly and you break even or even, again, you have to whisper this one, lose money, because you can do that sometimes. But I'll take the kind words for what they are, James. Thank you very much.
Absolutely.
So, Adam, you shared a lot of wisdom there, as always. What's the most important thing as it relates to the property market in 2026 that we haven't talked about yet?
Ooh, right. So we'd have to kind of ignore renters' rights and things like that. Probably, I think it would be housing providers and arrangements with housing providers. So obviously, I'm wary about talking about this, Luke, because it's become the latest shiny penny. And what you're seeing is a lot of people get into this sector not for the right reasons, which I'm not keen on. I've been in this sector for 12 years now. And I'd like to think I've been in for the right reasons, but I'm also still very commercially minded, as probably unashamedly commercially minded, to be honest with you, because if I'm not, then the operation doesn't work, right? But I do think we're going to see more and more people pushed out of the assured tenancy. We're probably not going to call it that, are we? Because there's already assured tenancies, but the non-AST route that won't exist anymore. And they'll get pushed into some form of local authority sponsored provision. Local authority hasn't got houses, hasn't got stuff that's ready. We'll have to lease that from the private sector. We'll probably do that through a housing provider or someone like that. And I think that sector is going to see relatively meteoric growth over the next few years. I think some of the legislation creates a new strata of tenants, if you like, that will be more difficult to house. But it won't be like it used to be where, well, we know that, Ashley was in prison and that's why we won't give him a tenancy. Credit files become loads more important. Referencing is becoming loads more important. And every sensible agent and landlord will be ramping up, reviewing their procedures, ramping up who they will and won't take. And there's going to be more and more pressure on council tax budgets and all the rest of it with the statutory duty to house. The only people that can solve that are the people like us around this table who can supply units to providers on leases, right? And I think there's lots of good stuff about that. We're not directly exposed then to the Renters' Rights Act. That's going to be a big bonus. So if I'm telling you over here, you've got to do more effort, more risk, or over here, well, actually, these guys, they're paying market rent these days because they can't get the houses. So they're paying more than they were, and your comparative risk and effort is far lower. Well, hang on a second. Isn't it time to put your hand up and go, I might need to look into this? And also, again, don't do what most people do and go, I've heard terrible stories about Serco. Okay, well, let's verify and validate some of those stories, right? Let's remember, I always look at it this way. I never want to sue anyone, right? But if I'm going to sue someone who's got something to lose and got some resources, yeah? So if Serco break a contract with me, what am I going to do? I'm going to put them under pressure. I'm going to send them through the money claim system. I'm going to litigate if I need to, and I'm probably going to win, yeah? Or they're probably going to fold before that. If Mrs. Miggins hasn't paid, and actually she's fallen on hard times and this, that and the other, and then you see her on Facebook and she's nipped over to Costa Rica or whatever for a little holiday, we're annoyed about it, but it's much more difficult to recover those sorts of funds when they're gone than it is from the Sercos of the world. Not that I'm endorsing only working with Serco by any stretch of the imagination. There's lots of good providers. You have got a chance to put your own social purpose spin on it, which I'm a big fan of. So big fan of social impact investing, but once again, with commerciality behind it. I've signed lots of these contracts that haven't made as much money as they would have done if the house had been in the private sector at the time, for example. But the effort's been lower. The covenant strength, the credit risk side of it has been eliminated altogether. Well, therefore, like I said, as a rational investor, I'd expect a bit less return. But on some of these, again, really shouldn't say this on video, but I'm going to say it. Some of these I'm getting more money and less risk and less effort. Well, tell me about the no-brainer, right? Exactly.
Yeah.
Yeah, but more than the mythical creature, more of them around than the mythical creature.
Yeah.
Yeah.
Magic dust.
Yeah.
Magic dust. There is the magic dust. We've done it.
Magic dust. We've done it.
Run to the back of the room.
Yeah.
So, I mean, in summary, I think what you're explaining is, because what I'm hearing there is arbitrage.
Yes.
Knowing the difference between the benefits of opposing investment strategies and knowing where there's still market opportunity and where there's less market opportunity, and making your investing decisions based around that knowledge and understanding which you are the king of.
Well, I'm never going to argue with that, am I? But you have. I already liked you, and now you've used one of my favourite words in the dictionary, arbitrage. And if anybody watching or listening to this then goes off and thinks, well, I'd like to know a bit more about arbitrage, it's a phenomenal word to Google, right, and learn some about it. But that's exactly, pricing risk can lead to arbitrage, and that can lead to exceptional outcomes for investors. And if you want to, you know the old saying, do the same as everybody else, get the same results, right? You want to do something different, look at how you can arbitrage. What lots of people listening to this perhaps don't realise, but they've got tons of skills that I haven't got. There's so many things that I'm rubbish at, right? And I have a bigger operation, which means there's more costs associated with things. If you can do the bit that you are good at, but also that you enjoy, you've won. You've won 2026 and beyond there. Do you know what I mean? And you could easily be better at it than me. So go for it.
Fantastic. Well, what an amazing episode. And before we finish, I do want to thank our other sponsor, Blue Bricks Magazine. And Blue Bricks Magazine, I'm always a big fan of the fact that we don't just go online and get distracted by all of the things we could read, particularly with AI now. Hard copy, print and paper, brought to us by people who know what they're talking about, who actually allow us to identify these kinds of trends that you've been talking about, today. So Blue Bricks Magazine, give them a look, get them in your inbox so you've got one thing to look at that you know is going to provide you value. Who else do we want to say thanks to, James?
A final one for the optimized entrepreneur. So I've been working with those guys for quite a while. They have made me significantly less porky. So always a good thing. So I can still eat curry. I've got no brain fog. I've got no lethargy, and I feel energized. I've lost, knocking on 2 stone. I cannot speak highly enough of those guys. They're the reason why I'm really able to sort of power ahead and get the stuff done that I need to do. And I think that's about it from us. So please get yourself along to your local property and poppadoms meeting. We have our first national event taking place on the 31st of January, Saturday the 31st of January, 9 till 4 at the Village Hotel in Solihull. We have Ben Beadle coming along as a keynote speaker, talking about renters' rights, and also Land Bay. And they're going to be talking about the lending landscape for 2026. So we hope to see you there. We're very nearly sold out. Adam, thank you very much for coming in.
Always my
always.
pleasure. Thanks for having me.
And of course,
again.
I'll be there at the
Yes.
national event as well,
We'll be there
James,
as well.
to make goal setting a lot more easy. Can be overwhelming. It's just too much to think about. How do we make it light, easy, and achievable? So I'll be talking about that. So we look forward to seeing you there.